Chapter 5. A Statement of Cash Flows. Consider this cartoon. Unfortunately, the sources of cash flow problems may not be as easy to identify in practice, but they can be extremely detrimental to any business. Pause this presentation now to work through 5.1 baseline assessment and check your answers in the solution booklet. A statement of cash flows. Cash flow is vital for the survival of any business, as without sufficient cash to be able to pay debts as they become due, the business will not be able to operate properly in order to generate the much-needed income and profits. Although cash flow and profitability both indicate how well a business may be performing, they are actually quite different. Cash flow indicates the actual cash coming in and going out of the business bank account, whereas profitability, as shown on the statement of income, indicates the profits being generated by the business and will determine possible future growth. The statement of income shows incomes and expenses. If you look at the cash items here and exclude non-cash items such as depreciation, this will give you an indication of cash flow from running the business day to day. A comparison of the statement of financial position for 2 consecutive years, this year and last year, will help you to see how money has been generated from financing activities, as well as how it has been invested in non-current assets. A careful analysis of both these financial statements in this manner will allow you to determine the cash flow for the period. A statement of cash flows can then show you where money was obtained. A loan might have been taken out, shares might have been issued, etc. It will show you how the money was spent on tangible assets or on increasing investments. For example, buying new vehicles, land and buildings, equipment, etc. One can see how the cash balance has changed from the beginning to the end of the year by looking at the changes in bank, and you can see now where the money has been spent. Possible cash shortfalls might be identified in spite of profits having been made. Possible liquidity problems can hopefully be rectified as quickly as possible. Without a cash flow statement, the management may be unaware of imminent business failure if the profits look good, even though there might not be enough cash to operate. Consider this cartoon. What news do you think the man in the striped suit is about to give? This cartoon clearly shows how one can't assume that all is well simply by looking at the profits or the orders coming in. In this case, it appears that the news of the cash flow is not good, as this man is looking distinctly unhappy. Probably what is happening is that customers are placing their orders but might not be paying on time. In order to be able to better understand the layout of a cash flow statement, one needs to understand these basic concepts. Operating activities refers to all those activities involved in the day-to-day running of the business. When looking at the cash effects of operating activities, one would need to consider all the short-term activities in the financial statements, in other words, the profits from the statement of income, as well as changes in the working capital. In other words, changes in current assets and current liabilities shown on the statements of financial position at the beginning and end of the year. Investing activities refers to those activities that change the non-current assets in which the company has invested in. You would need to look at tangible assets such as land and buildings, vehicles and equipment, as well as financial assets or investments, and see how these balances have increased or decreased, indicating a change in cash. Financing activities refers to the changes in the sources of capital, both own and borrowed capital. One would need to look at the changes in equity as a result of selling or buying back shares, as well as new loans taken out, and any repayments that might have been made on the old loans. Again, you would look at beginning and end balances in order to determine the cash effect. These 3 areas are then added together to determine the overall effect of the business's activities on cash flow, or the net change in cash. This should be the same as the difference between the cash balance in the bank account at the beginning and the end of the year. If it is not, You know you have made a mistake somewhere. You will then need to go and check your figures very carefully. Now work through 5.2 case study, which is based on a very basic statement of cash flows showing these three sections. Remember to check your work carefully from the solutions booklet when you're done and make detailed corrections.